Good morning, everybody, and thank you so much for joining us today for our first iteration of Coffee with Forethought, your guide to markets and smart planning. Before we dive in, just some quick disclosures for you. Everything that we talk about today is for informational purposes only. Please do not take it as personal, financial, or investment advice. Always consult your other advisors. And for a full set of disclosures, you can find those online. Now, by way of introduction, before we get going here, my name is Joel Johnson. Quick background on me. I've now been with FourThought for 2 years after a career as a portfolio manager working with ultra high net worth individuals and institutions. And I'm joined today by Jake MacFarlane, our senior research analyst. Jake, you want to give a quick intro of who you are?
Yeah, absolutely. So I'm Jake MacFarlane. I've been with FourThought coming up on 6 years now, and my whole entire career here has really been spent on the research and investment management side. So I head up our research efforts here, both on the public equity side as well as investment strategy and private market strategy too. So Joel, excited to really kick off this series with you. And by way of kind of introduction and our goal for this series is really to provide these webinars to give a little bit of a personal economic pulse, so to say, a look at not only the markets and the economy, but also to give some timely investment and planning conversations. This could be something about our investment philosophy and how we look at companies and research them. And it could also be planning topics too, such as, kind of what the recent market moves mean for tax and for retirement planning purposes.
Yeah, absolutely. And our goal is going to be to bring this to you once a month. So we hope you join us each month. And let's go ahead and just a quick reminder that we will be doing a live Q&A after our presentation today. So at the very bottom of the screen, you should have a Q&A box. Feel free to type in a question there. We'll be answering those at the end of the session. And if we can't get to your question or we think it's better to follow up one-on-one because again, we can't give individual advice during these, we'll make sure that one of our planners or Jake or myself follows up with you after our session today. So for today, we have some key topics that we're going to be touching on. First, we're going to start with where the markets are now, a quick recap on what happened last month. We're going to do a check-in on the economy, see how it's looking, because I think what I'm sensing from a lot of the conversations we're having, and Jake, correct me if I'm wrong, I think people are thinking the economy is doing a little worse than what the numbers are telling us. So it's going to be a good check-in to get the pulse on what's happening there. We're going to send it over to Jake to do an earnings spotlight because we are in the throes of earnings season, which is where these companies are giving us their report cards for the quarter. So we'll be touching on that. And then we're going to do a quick introduction for our current clients about what they can expect in their upcoming planner meeting over the next 6 months or so. So starting here with some key market performance, and let's kind of revisit what actually happened last month. So on the far left there, we're looking at four of the indices that we take a look at. You've got the S&P 500, the Dow Jones Industrial Average, the very tech-heavy NASDAQ, as well as an international index. And we're looking at a 1 month period of performance for those particular indexes. And it just tells us kind of where the markets were and what led the way. And for last month, it was all about tech. And Jake, kind of what did you see happen last month? What did you think kind of allowed tech to lead the way over that 30-day period?
Yeah, absolutely. There was a lot that happened over the last month. As you mentioned, we're in the middle of earnings season, and it's been a pretty big one. There's a lot of weight and market anticipation that was kind of waiting and seeing how Nvidia would do. And so if we look at that stock over the last month, they're up 24%, right? So doing much better than really all of the indices here. So corporate earnings overall, we'll get into that when we look at that snapshot, but that's been certainly a driver of stronger returns. But also we've had some impacts on the tariff discussion. We had kind of earlier in the month some pullback kind of towards that pre-Liberation Day tariff kind of policy there. So the market really liked that. And then we saw, again, some maybe doubling down, especially looking at the European Union. Then we also got a court ruling that basically said that Trump doesn't have the power to do that. And so I think overall the sentiment has been positive with maybe seeing fears of inflation that was kind of being brought forth by tariffs. Maybe that's coming back a little bit, but still the uncertainty of kind of how this is going to end is still elevated. So we're paying pretty close attention there. Um, but what I think is really important too is taking a step back and widening out a little bit, with which is the chart on the right hand side. It looks at the same indices that we talked about before, but instead takes a look at the last year, the trailing 12 months. And here I think you really start to see some divergent paths between the different indices. Like for example, in the green, that's the MSCI EAFA. That's basically the international index. And you can see that for a long time, really from May of last year to the beginning of this year, that index really struggled against the domestic markets. But since the beginning of this year, the green line has ramped up faster than any of the other ones. So again, I think as we think about building a all-weather portfolio, you have to build it with different components, whether it's from a geographical standpoint or it's from a style standpoint. Even though the NASDAQ, kind of a growth-heavy, technology-focused index has done the best over the last 12 months, it's been very volatile. And if we would have ran this maybe a month or maybe a couple months ago, it would have not been doing the best, and international would have been outpacing. So again, as you build that, you want to kind of view it as pistons in an engine, where you have some are advancing, and some are pulling back. You really just are able to build a more well-rounded portfolio there.
Yeah, absolutely. And I think it's a great point about diversification, Jake. And one of my favorite charts that we don't have here today, I'm sure you've seen it, is the quilt chart of all of those different indices and how they've performed over calendar years. And there's no one that is just always at that very top. And so if somebody would like to see that chart, please reach out to us. We're happy to send it your way. But it does tell a very powerful story. And I think the big key here is always taking that step back and looking at the bigger picture, and not just a 1 month period, but over time, what are these different indices doing and what's happening in the markets? So next here, we're going to take a quick look at the Treasury yield curve and kind of get an update on what's been happening in the bond market. We're not going to spend too much time here because fortunately, there hasn't been a whole lot of news in the Treasury market too much. There certainly has been some, and there's going to be more towards the end of the year, I'm anticipating. But what we've got here is the yield curve today, about a month ago or 30 days ago, where that same curve was, and then 1 year ago. And very often, what we're looking for when we're looking at this chart is the health of the economy as told to us by the bond market. And so it's a very efficient market. And what it's telling us is how comfortable are investors with giving their money to the US government for a long period of time. And that is what really drives the yields here. And so if we're comfortable with them, we're going to expect lower yields. If there's some uncertainty in the market, we're expecting higher yields. And a healthy yield curve is going to be lower on the front end and higher on the back end. And that's kind of where we're getting to today. It's almost even more of a flat yield curve at this point. So that really gives the impression that we're in more of a wait and see with all of the things that Jake was just mentioning, with tariffs, with earnings. There's just a whole lot going on out there that we need to be aware of. But you see that since last year, we're actually in a much healthier spot. Last year, on a 1 month treasury bill, you were getting almost 5.5%. And to lock up that same dollar for 30 years, it was almost a full percent lower than that. And so that's really, it's not an unhealthy market per se, but it's definitely something that we're keeping an eye on. We did last year. We did make some tactical moves for some of our clients around that. But the general takeaway on this chart for today is that we're moving into a healthier space on the yield curve. And just the
And
last point that I'll make here is there's always a lot of conversation around the around Jerome Powell and what they're doing with interest rates. The Federal Reserve really only has control over the front part of the curve. So anything about 2 years and in, they're going to have a lot of say over what's happening with those rates. Everything beyond that is very much market driven. But what we're looking at is the entirety of this curve and kind of trying to predict, or not predict, but trying to keep an eye on what's going to be happening and do we need to make any changes.
Yeah, it's a great point. I was just going to echo that, and also the last thing I'll add is a lot of times investors and it's like headline news, right? Of oh man, Treasury yields increase, 30 basis points over the last month, and a lot of times it's looking at the long end of the curve and really trying to maybe not fear monger, but we know that that those type of headlines can get eyeballs to look at them. But again, once we widen out and see kind of where we're at today versus 1 year ago, if you go out 20 and 30 years, it's a little bit higher than we had a year ago. But I think, as Joel was saying, which is so true, is we're getting more into just a normalized curve, which is one that you would expect to earn an additional premium to lock your money up for a 20 or 30-year period than you would for a 1 month period. And we're still not exactly there yet, but it's a process that's kind of ongoing, and I think it's a more healthy one. One thing maybe to just that we're keeping our eyes on is kind of how investors are going to deal with the supply of treasuries that might have to come online to continue to fund the deficit that's still growing. And so one thing that could really put upward pressure on yields is if investors who are buying our treasury bonds say, hey, you guys are pumping out too much. We need to be compensated a little bit higher in order to keep investing here. And so that could lend additional upward pressure there. But right now we're seeing a pretty healthy dynamics here on the bond market side.
Yeah, absolutely. And that is a great segue into our check on the economy. And so this is what we call our holy grail, which is just a fun way of looking at what we think are some of the key economic indicators that are out there. Some leading, which means they are kind of foreshadowing economic indicators, and some lagging, which is just it's already happened and we're just checking on kind of what's happened in the past. And so you see going down that list there, we give each of these indicators kind of a red light, yellow light, green light on where they stand for each of them and what we would consider to be a healthy data point. And so when we look at the last release for each of these indicators, the one that really sticks out to me is that GDP, the real GDP growth. And I'm sure a lot of folks saw this headline, but our real GDP was actually negative as of the last reading, which which would be the first indicator leading us into a recession. Recession is 2 quarters of negative GDP growth in a row. And so this was the first of what could potentially be two of those leading us into what would be a recession. What I'll point out, though, is that this was a very odd reading of real GDP growth because of those same tariff talks that we were discussing previously. What a lot of companies and folks were doing was purchasing overseas goods more rapidly than they would in a normal economy to try to get ahead of those tariffs. And so our imports went up very significantly in this kind of snapshot period. And imports is one of the key things that we look for when calculating real GDP growth. And so we were only slightly negative on the reading. And a big portion of that, not all of it, but a big portion of that was because of those significant increases in imports. And so it's certainly an indicator we're going to keep an eye on for the next upcoming reading. And so we're keeping an eye on it, but it's not something that we're saying we can't explain or that the actual underlying economy is in any kind of trouble. When you look at all of the rest of these indicators here, outside of housing and the labor market, the numbers are actually fairly good when it comes to the economy. So we're still relatively positive on the US economy moving forward through the rest of the year, but not to say that that doesn't have its risks. And so we're going to check in on this every time that we have this discussion just to make sure that we're staying ahead of things as we need to.
Yeah, just a couple of things to add there. I love this chart right here. I think it encapsulates kind of a lot of the key economic data points we look at. And a couple ways to frame it here is, for example, Fed Jerome Powell will really consider the L and the I to a really great degree as their dual mandate there is strong labor market, or full employment, and moderate levels of inflation. And so kind of seeing where those items are heading, we see inflation's in green right now. And over the last year, CPI or inflation is at just about 2.3%. And we've trended we're darn near close to that long-term kind of 2% target. And we're kind of on our way there. Now, there are concerns about kind of longer-term inflationary pressures from tariffs, and so that's not going to be priced in yet. But certainly on that front, we're in good shape. For the labor market, again, it's yellow right now, but at unemployment level around 4 to 4.2%, we're really not in bad shape there either. Although that is showing some signs of weakness versus the inflation front, and so potentially there could be room for maybe some more dovish policy, or maybe some more decreases there to the federal funds rate. But I think right now they're kind of a little concerned about what the tariff uncertainty might bring. Housing starts, again, that one's in yellow. And as we were kind of talking here, it's kind of to be expected as we had this kind of oversupply rubber banding that happened post-COVID with housing starts, especially here in the Florida market. And so we're starting to see that pull back a little bit, which to us is kind of more of a normalized market there.
Yeah. Great points, Jake. So like we mentioned at the beginning, we are in the throes of earnings season. So Jake, why don't you kind of walk us through what these companies have been telling us?
Yeah, happy to do it. And one thing maybe before I jump into the companies is, Joel, you kind of teased this a little bit earlier in that there's a bit of a difference between, I think, how the average investor is feeling right now versus what the data is showing us. And so we just looked at the economic data, which for the most part is in pretty good shape. We're going to talk about earnings here, which I'll give you a hint, are in pretty good shape for this last quarter. However, if we look at like the University of Michigan Consumer Sentiment Index, that is like near record lows. And investors and consumers aren't feeling very confident right now at all. And if we look at the levels, it's like stuff that we saw back in kind of the COVID days or even like the great financial crisis. Like that's how bad the confidence level is. And so that is always a really interesting kind of relationship there. Oftentimes that when confidence is low is kind of a good time for market investment when you look over the next year. Now, we're not, forecasting that that's going to happen. There's so much more that goes into it than that. But just to point out that confidence is low. Now, getting back to the earnings results, I think that we still are in a position where the Mag 7 is kind of driving the market right now. These are highly weighted companies within the overall S&P 500, like huge positions. I think in the top 10 holdings is still over a third of the total market cap or of the total weighting of the S&P 500. So it's substantial. And when we look at those Mag 7 companies, that's your Microsoft, Nvidia, your Amazon, Meta, Tesla, et cetera. 6 out of those 7 companies had positive earnings surprises, which means that for the guidance that they gave and what Wall Street analysts expected them to do for the quarter and profits, they actually exceeded that. And so that's very, very positive. And in fact, almost 28% growth in earnings for the first quarter this year. Now, kind of pivoting to what I call the other 493, the other stocks in the S&P 500 there. Almost 80% of those companies reported positive earnings surprises too. And although the earnings growth is lower than the Mag 7, it's almost at double digits level. So when we look there, kind of broadly speaking, it's been positive for the Mag 7 as well as positive for the other companies within the index. Now, to pick on 2 companies here, Nvidia and Salesforce, these are companies that we track very closely. We see kind of what's driving these companies in terms of like market reaction to the earnings. Both of these companies beat expectations on revenue and on profit, so top line and bottom line. They both had kind of some good and some bad discussion points in the management discussion segment. one company was up 5% and one company was down 5%. So NVIDIA was up, even though they announced that this export ban that the US has imposed on exporting their chips to China was a multi-billion-dollar hit to them. So that's not good. They're still up 5% because guidance is great, demand is still strong, and the AI trends for NVIDIA are acting as a huge tailwind for growth. For Salesforce, on the other hand, they were down 5% after the announcement. And broadly speaking, it was during the management discussion, they kind of talked about their AI growth being somewhat modest for the next year. And so as we pull apart, like both companies be on key metrics, raise guidance, a lot of good, a couple bad news, but really the market keyed in on the AI trends for both of those companies.
Yeah, it's certainly been a topic. That's for darn sure.
Yeah, and I think this next slide too just gives a little bit of an insight to how we view companies in terms of consistency. A key pillar of our investment philosophy is to try to identify great businesses that can grow earnings sustainably and consistently. And one way we do that is from what we call a consistency score. And this is a blind review of two pharmaceutical companies. So company A versus company B. And on the left-hand side, or really for both companies, I give really the last 5 or 6 years of earnings per share numbers. And you can see that company A made $3.12 per share in 2019. And this past year, they made $5.47 in earnings. Company B made $3.81 in 2019. Last year, they made $6.74. If you just look at pure growth of these two companies on the 5-year metric, company A is growing at 11.8%, company B growing at 12%. Pretty apples to apples. However, when we look at the standard deviation or the variance and volatility of that year-to-year growth, you see company A has grown in a very linear path with no years of like year-over-year decrease. Whereas company B had 2 separate years of pretty big negative growth in earnings. So that would be 2020, where they went from $3.80 to $2.78. And then again in 2023, where they had made $5.70 per share, and then the next year just 14 cents per share. So what that does to kind of the risk of those earnings growth profiles, for company A, you have a standard deviation of around 7.5%. For company B, you have a standard deviation of over 2,000%. And so what we try to do is we try to right size the growth over the standard deviation to get to a consistency score. And company A, taking the 11.8% growth divided by the 7.5% deviation, gives us a score of 1.55. And for company B, you have 12 divided by 2,000, a score of 0.005. And for us, we look for companies that have a higher consistency score, just shows a more linear path. And again, we're not trying to, hit home runs in companies that have binary outcomes that can have huge earnings growth periods and then really negative growth. We want this consistent march. And we think that really shows telltale signs of a company that has competitive advantages and pricing powers, network effects, and just things that we believe make a great long-term investment.
Yeah, Jake, I like to call this fun with numbers because there's a lot of different things we can do, right, to tell a story using numbers. I think your EPS growth there is a great example of that. And so it really it reiterates the necessity to kind of go beyond those headlines and really dig into what those numbers actually mean before coming to any sort of decision when it comes to doing this sort of analysis. So I think it's a great example. Now, switching gears here before we wrap up and move to our Q&A session. As a teaser for our current clients are going to be very familiar with our planning process there at the bottom, 4 parts to it. And today I just wanted to touch on the body there, 3. What we're looking for is blind spots with our clients. And we have a different conversation every 6 months to take care of the parts of the financial plan that we don't talk about on a day-to-day basis. So certainly investments always top of everybody's mind, but there's a bunch of other parts that we need to make sure that we take care of over a full financial planning engagement with our clients. And so for the next 6 months, our clients can look forward to sitting down with their planners, and we're actually going to be talking about cybersecurity. It's becoming incredibly important to have a great cybersecurity plan in place. You see headlines all the time about the new scams going on. I can't tell you how many UPS packages I've had at the carrier that I need to go pick up and just click on this link here, right? It's happening more and more often. And so having a good cybersecurity plan in place for when those do hit your computer or your text messages, it's very imperative. And so we're going to be walking our clients through that and helping them set up a good plan. So please look forward to that. And with that, thank you so much for joining us today. We're going to move to our Q&A session now. And if you know anybody who would find this of interest, we will be doing this again next month. So please feel free to give them our information, send us their information, and make sure to connect with Jake and I on LinkedIn and follow us there, where we're going to be sending you some pretty regular updates and things that are going on in the markets over time. So thank you again for joining us, and we're going to move to our Q&A.